What up, investors? Fondly here, bringing you another episode of Finance, where I keep you plugged into the markets. This week, we're going to dive into the latest GDP figures, as well as some trade news, and I'll explore why index funds are a better way to invest your money than traditional actively managed funds. So let's do this. Let's check in with the markets. Since it's the beginning of the month, let's take a step back and look at the big picture. Sometimes it's good to get a view of the forest instead of just the trees. Here's the S&P, Dow, and NASDAQ looking back over the past 12 months. It's nice to see the markets climbing back after a brutal sell-off at the end of 2018. Keep your fingers crossed, we may even get back to those old September highs. Now let's drill down into this past week. Here's the 5-day chart. We ended the week slightly lower than where we started, but nothing too crazy. Okay, so what were some of the key takeaways from this week? First, GDP. GDP stands for Gross Domestic Product. It's kind of like a country's economic report card. To get a little more technical, it's the total value of all the goods and services produced in a country. So when you go out and buy a new pair of sneakers or get a haircut, or when a company goes out and builds a new factory, all that is captured in the GDP number. The GDP number that came out this past week was for the fourth quarter of 2018, and it showed that the US economy grew by 2.6%, a solid passing grade. For the US, if you ask most economists, they would probably say growth between 2 to 4% is generally considered healthy. So the US economy looks like it's still in pretty decent shape. Now let's talk trade. We saw some more promising signs on that issue. The White House extended that March 1st deadline indefinitely. So tariffs are off the table for now. And the media is reporting that the US is hammering out those final details to present a deal to China, which could get signed in the next couple of weeks. All good stuff. I'll keep you posted. On to this week's main topic, index funds. Thought they might be worth mentioning since Warren Buffett highlighted them again in this year's Berkshire letter. So if you remember from last week's episode, Warren Buffett is one of the greatest investors of all time, but he's also the chairman and CEO of Berkshire Hathaway. And every year, he writes a letter to discuss the Berkshire business, but he also sprinkles in a little bit of advice on investing in life. His letter is highly anticipated by investment geeks. You know how kids used to look forward to Saturday morning cartoons? Well, that's how I feel about Buffett's letter. One topic he consistently talks about, and did so again this year, is how most folks should be investing in low-cost index funds instead of traditional actively managed funds. Let's break down those two terms. An actively managed fund is your traditional mutual fund, where you give your money to some smart people and hope they pick stocks that go up and beat the benchmark. Then you have index funds, which are passively managed funds, meaning there isn't anyone picking stocks. Index funds just try to copy a benchmark to generate the same returns. So if the S&P has 500 stocks in it, an index fund will go out and buy those same 500 stocks just to match the performance. Contrast this with an active fund, which may only buy, say, 100 stocks that they think will generate higher returns than the S&P 500. I keep mentioning benchmark. What's that all about? A benchmark is just a measuring stick, or a way to gauge whether an active manager is doing a good job. Say an actively managed fund generates a return of 11% in a year. You might think to yourself, that's pretty good. But if the benchmark that he's competing against generated a 12% return, that doesn't look so hot. You think that super smart people with fancy degrees getting paid millions of dollars a year would be able to beat their benchmark most of the time. But you'd be mistaken. And Warren Buffett explains why. Fees. So in his letter, he takes us all the way back to the first time he bought his first stock in 1942. He was 11. Yes, 11. At that age, I was playing Transformers and G.I. Joes, and this dude was memorizing stock tickers. Cuckoo. Anyway, at the age of 11, he had saved up $114.75 to invest into the stock market. If he had taken all that money and invested it into a no-fee S&P 500 index in 1942, today, that investment would be worth more than $600,000. That's a gain of 5,288 to 1. But imagine if that fund charged a 1% fee. Can you guess how much the investment would be worth? Half. Half, people. So around $300,000. Look, that's still obviously a ton of money. But the point is that you're leaving a ton of cash on the table if you let fees eat into your returns. And I should note that Warren B puts his money where his mouth is. In his will, to make sure wifey is taken care of after he's gone, he's directed his trust to invest 90% of his money into one investment, a low-cost S&P 500 index. So if it's good enough for Warren B in the afterlife, it's good enough for you and me. So stop throwing away that hard-earned cash and invest in low-fee index funds. All right, hope you found this week's episode helpful. If so, hit that like button. And if you have any comments or questions, let me know. And be sure to tap and subscribe to stay plugged into the markets with me. Until next week, stay up and invest wisely.
Please try not to cry on me. Now that all my dreams are manifesting.